I'm going to give a very sort of high-level overview of the trends we're seeing in the occupational market in terms of luxury, what that means in terms of the investment market, and probably of more interest to the investors in the room, what we consider to be the top investment pick markets for 2018. A trend that we picked up last year in terms of the occupational market for luxury brands is a refocus on the destination markets in the US and Europe and a move away from mainland China. And this was largely in a response to a softening in consumer spend amongst Chinese buyers of luxury retail. Now, this is a trend that has intensified this year. And this is quite easily shown through this visualization. So this is all luxury store openings. So these are new openings. We don't count relocations or reopenings due to refurbishments. And the overall trend compared to last year was a decline in the number of new openings. So we expect to see about 350 brand new store openings by luxury brands this year, but this is about 27% down on the number we saw last year. But what was reassuring for Europe and also North America was a refocus on the key destination markets. And in terms of proportion of new openings, we actually saw an increase in Europe. So the market share in Europe increased from 36 to 38%, and in North America from 15 to 20%. And this coincided with a decline in market share in China, so falling from 9% to 5%. And, this coincides with, the reports that we've seen in the news about luxury brands closing stores in mainland China, particularly in sort of second, third-tier cities where there was an oversaturation. And in terms of what were the top 10 markets globally, well, it was the usual suspects. So we're talking about the big global cities, in particular those that attract significant number of international tourists. Where we did see a bit of a change this year was in the order of the rankings and also some new additions to the top 10. So Paris was actually the top ranking city for new openings this year, outperforming London, which topped the ranking in 2016. Now, a lot of that has been driven by an improvement in luxury spend and a return in tourism to Paris. London, New York moved down the ranking. They were probably suffering the effects of the slowdown seen in global luxury sales in 2016, which was exacerbated by very high occupational costs. And the new entrants, well, we saw Los Angeles, Toronto, and Kuala Lumpur feature for the first time in the top 10. And the features common to all these new entrants is they are cities that have seen an improvement in domestic spend, but more importantly, they have seen an increase in international tourism and in particular Chinese tourism. And for Europe, again, unsurprisingly, we saw the usual cities appear in the top 10. So these are the big key urban centres in Europe, and particularly those cities that attract significant number of international tourists. Although it was interesting to note that markets such as Madrid and Barcelona didn't feature in the top 10 this year. New entrants to the Europe top 10 were Florence and Oslo is a particularly interesting market. It's not a big market, but it does have a very affluent local population, and it has also seen an increase in tourism over the last 18 months, and that's driving appetite from luxury brands to open new stores there. And in terms of the types of locations these brands have opened, well, the huge majority, 80% of all new store openings in Europe were in high street locations. Now, these are locations that appeal as well to a domestic market, but also to a visitor market. So while we didn't see a shift in terms of, the top 10 cities, where we did start to see a bit of a change was in the parts of the luxury market that drove expansion in 2017. So we saw increased activity from the accessible luxury brands. So they accounted for about 45% of new openings this year, up from 38% last year. If you're not familiar with accessible luxury, well, these are luxury brands but with a price point lower than their sort of ultra luxury counterparts such as Chanel, for example. So we're talking about brands like Michael Kors and Kate Spade. What's interesting about this part of the market, particularly in terms of occupational demand, is that in the larger cities in Europe, they are brands that can support more than one store. So that does present an opportunity and does suggest we could see an increase in occupational activity across Europe if these brands continue to expand. And in terms of the product classification, well, it was the fashion sector that continues to dominate, accounting for 63% of new openings. But we did see a proportional increase in activity and also in terms of new store count amongst luxury watch brands and luxury bag brands. So for bags, their market share in Europe last year was about 5% of all new openings, and for watch brands it was about 6%. What's interesting about the luxury watch brands is, as well as opening more stores, so they're developing their own mono-brand boutiques. These boutiques are also getting larger. So the average store size for new openings in London, Paris and Milan was about 300 square metres this year. Last year it was only 100. So for these brands, they're looking for, the bigger statements to improve customer engagement, but also the extra space to provide VIP facilities in order to drive sales. So why are we focusing, or why are brands focusing on destination markets? I partly alluded to this already. It's really down to tourism, and in particular, Chinese tourism. And, the reason why Chinese tourism and Chinese spend is so important is highlighted by the fact that in 2016 we saw a softening in global luxury sales, about 0.4%. Now, this was driven by 3% decline in Chinese luxury spend, even though non-Chinese spend actually increased by 2%. And this is because they are now the single biggest consumers of luxury products in the world. So they account for about 30% of global spend, and about half of that actually takes place outside of their domestic market. So where Chinese tourists go, they are markets that are increasingly appealing to international luxury brands. The good news for this year is that luxury spend by Chinese nationals actually increased significantly by 11%. And what that meant for the global market is that sales actually increased by 5%. And the 3-year forecast suggests that spend will increase by an average of about 4 to 5% per annum. So they are a very important consumer group. And what does this mean for occupational demand in Europe? It's really the driver is where this Chinese spend and where these Chinese tourists are going to travel over the next sort of 5 to 10 years. And Europe is uniquely placed in terms of attracting a significant volume of these tourists. So forecast to 2025 suggests that global international tourism will reach about 1.6 billion. Europe will account for the biggest share of those visitors. So about 43% of that 1.6 will come to Europe. At the same time, Chinese outbound tourist numbers are forecast to increase to 300 million. So a significant increase, particularly in light of the fact that I think it's estimated that Chinese nationals, only about 4% actually hold a passport. So you probably only need to get to about 10% to see a significant increase in outbound travel. And in terms of their destinations of choice, well, the forecast is that Europe will capture about 10% of that 300 million. Now, what this means is that Chinese tourist arrivals to Europe could increase by about 200% between now and 2025. They will be a significant driver of international luxury spend and, as a result, be a driver of occupational demand in Europe's destination cities. And, we're very confident that luxury brands will maintain their focus on key markets in Europe. The question is, what markets actually look to be more attractive for expansion amongst the luxury brands. Now, this excludes Paris and London, which will, of course, always continue to be key expansion targets for retailers. And in order to sort of identify the opportunities or the growth opportunity markets, what we try to do is look at the local domestic environment, so in this case the number of high net worth individuals, and benchmark that against the number of international tourist arrivals. We then look at rents. So the size of the bubble reflects the prime rent in the key luxury location in that given market. Now, the cities that stand out on this basis are Frankfurt, Munich and Madrid. Now, Frankfurt and Munich, they have very affluent local populations, but more importantly, they're becoming increasingly appealing to international tourists, and in particular, Chinese tourists. And also, if you look at the rents relative to Milan, and in particular once you compare against Paris and London, they look relatively more affordable as a luxury location. In the case of Madrid, the local dynamics are probably not as positive as Frankfurt and Munich, but it is a market that does attract a significant number of tourists. And also in terms of rents, it is very affordable compared to other markets. And this aligns with the target cities identified by luxury brands themselves. So we carried out a survey of 35 luxury brands, including a number of the key luxury groups, and we asked them to identify their target markets for 2018 and 19. Now, the cities that had the most mentions in Europe, because Paris and London also featured very, very highly, was Frankfurt, Munich, Madrid, Vienna and Milan. Now, bearing this in mind, and also in terms of the affordability, our top picks in terms of rental value growth going forward are for Frankfurt, Munich and Madrid. So what does this mean for the investment market? Look into the wider retail investment market, so not just luxury and not just high street, but looking at total investment volumes across the whole of Europe. It does seem that confidence in the retail sector is under some downward pressure. So we saw transaction volumes in 2016 come off its 2015 peak, and year-to-date volumes are about 12% down on where they were in 2016. Now, the reason for this, we believe, is actually in response to some of the structural changes that's facing retail due to the growth in online. So that is tempering confidence in retail as an asset class. However, I do believe, some of this is overplayed. Now, fundamentally, in terms of total quantum, I think we will see a rationalisation in total retail floor space. However, the store is increasingly seen as an important part of a retailer's strategy. So now retailers are increasingly seen as a store to improve customer engagement, raise brand awareness, and to drive sales, not just in-store, but also online. And this is highlighted by the types of brands we're now seeing who are taking units in city centres. So the pure play e-tailers, a number of those brands are now coming into the physical store. So Misguided is probably one of the most high profile and recent example of this. They opened their first bricks and mortar store in Westfield last year. We're also seeing some of the traditional out of town retailers start to move into the city centre with showroom type concepts. IKEA opened their first city centre concept store in Madrid. And also the manufacturers, they are taking stores in our high streets across Europe. And for them, they're seeing that space as a way to, improve customer engagement, drive brand awareness. They're not necessarily trying to sell product from that store. It is all about trying to get customers to then go off and probably buy that product online or from another retailer. And while we've seen some rationalisation in terms of floor space demand in some parts of the retail market, some of this has been soaked up by the growth in F&B operators. So we've seen a number of international F&B brands expand their networks across Europe. I will flag that, while the store is far from dead, it does suggest that there is an increase in polarisation between prime and secondary in a given market. And we think that gap will start to widen further over the next few years. I do think that secondary will continue to play a very important role, but that role is probably going to be more sort of convenience and service-led rather than being a sort of a retail destination. So this refocus on destination markets amongst luxury brands and also across sort of wider international mainstream brands is reflected to a certain extent in pricing. Now, while transaction volumes across the whole retail sector in Europe is under downward pressure, prime yields across Europe's key high streets have remained relatively robust. And just to explain the chart, the blue bar is indicative prime high street yields and net initial yields, with the pinky triangle diamond reflecting the number of international arrivals in 2016. And you could argue that we're starting to see the visitor market, or the size of the visitor market, be expressed in pricing. So the highest visitor markets of Paris, London, Milan have some of the lowest, keenest yields. Now, on this basis, looking at markets such as Amsterdam and Barcelona, which also attract significant number of tourists, pretty much in line with Milan, look attractive, seen as prime yields are about 25 bips above what we see in Milan. So taking this a step further to identify, top target cities for 2018, we developed a weighted data matrix drawing on a number of data points related to market fundamentals, so size of the retail market, tourist arrivals, affluence, unemployment rate, which is very important in terms of the propensity for a local population to spend. We also looked at occupier terms, so the typical leasing length on the prime pitches, the rent review structure, to identify those structures that are more attractive to an investor. And then we looked at pricing, which actually we gave the lowest weighting. So current prime yields relative to other markets in Europe. And our top 10 were these. Now, London, despite being one of the most expensive markets to buy into, actually topped the ranking for Europe and actually topped the ranking globally. It remains a very attractive market for investors. The market fundamentals are very robust, and in particular, the occupier terms are very attractive. So if you look at Oxford Street, Bond Street, average lease length of about 15 years, and we've also got upward-only rent reviews. So that is very attractive from an investor perspective. Paris, again, very attractive market fundamentals, but some of the nuances of it, the leasing terms, make it a little less attractive to investors. Now, the big surprise in terms of the ranking was Munich. It is a much smaller market in terms of total sales compared to London and Paris, but it has very robust fundamentals in terms of the local population. It's attracting an ever-growing number of international tourists, in particular Chinese tourists, and really it's about pricing. It shows good value compared to other markets such as Paris. Other key target markets from our perspective would be Madrid and Barcelona. The local dynamics in terms of domestic population, perhaps not as robust, but they are big tourist markets and offer some value in terms of pricing. So as a bit of a sort of summary, and before we move on to the panel, our outlook for 2018, well, we think the rebound in luxury spend seen globally this year and going forward over the next 3 years will translate into renewed occupational activity across Europe. However, the focus will remain very much on strategic and underrepresented markets, and we probably will see at the same time some rationalisation in terms of store portfolios amongst some of the larger luxury brands. And for these guys, they're probably consolidating stores into a single flagship, a larger flagship based in a better location in a given market. Looking at the wider retail market, well, we think the structural shift in retail is perhaps overplayed, and the physical store continues to play a very important role, particularly in terms of driving online sales. However, we think the gap between prime and secondary in a given market is set to widen further. And in terms of our top picks and those markets that offer, good value for 2018 and 19, well, it's Munich, Madrid and Barcelona that look to be the most interesting markets. And on that note, I'll hand you back to Richard.
Right,
Thank you.